Loan officers is basically what they call mortgage brokers in the US. And I'll just read out these numbers. So in 2022, which was kind of just still coming off that peak, there was still, a decent amount of optimism in the market. There was 395,000 mortgage brokers. And so for context, there's about 25, depending how you count it, mortgage brokers in Canada. And so what is that? That's about 20 times the number of loan offers in the US. Okay, pretty good so far, pretty high numbers. 2023, there's 343,000, so that's down. 2024, 150,000. So it's halved. It's less than half the number. And now 2025, the number it's showing is 93,000. So if you still have that 25,000 mark, which was the Canadian number, we went from 20 times to 4 times, right? So it's just been a massive downsizing. But I think it deserves a little bit of an explanation of why is that. And I've talked to actually a couple of US brokers, not that we do a ton of business there, but I do chat with a couple of them. And the biggest difference, of course, is they don't have 5-year renewals, right? You lock in, a lot of people locked in 2021, 2022 at record low rates, and they locked in for the remainder of their term. They can literally lock in one of these mortgages for 25 years and just pay the rest of their mortgage at these super low interest rates. Hello, everyone. Welcome back to another episode of Mortgage Tech Talks. I'm doing this one from my living room, as you can see here. But in terms of content, I think it's a great show today. It's another market update. We talk about, again, ongoing Canadian-U.S. relationships and how some tech players in the space are using it to their advantage. And we're one of them for sure, not to our advantage, but we're using it to position ourselves in the right way. We think in the right way in the market. Quickly move on to a very interesting stat I saw about, yes, the US market, but what it actually means about, I think, lessons we can take away, I guess you could say, here at home in the Canadian mortgage market. Finally, I talked about a bit of an interesting story as it relates to Pinch Financial. If people know that platform, a little bit curiosity I had about it, and a big question, and then an answer that I got in doing my research for this episode. It's a pretty interesting story there, and I think the whole episode will provide a lot of value. So we'll see you on the other side. All right, let's get right into it here. So the first story I want to talk about here is a post that happened on ILMB a couple weeks ago now, kind of a response to some of the Canada-US stuff going on. I'm just going to read it out and then we'll talk about it. So this is by Jeff Willis. We had Jeff Willis on the program. He, of course, is the president, CEO, one of the two, of Newton Velocity. And he basically posted on ILMB a post talking about how proudly Canadian. So yeah, that's the image. It says proudly Canadian. But then the caption, I'll just read it out. It says, if you are a Velocity customer, you are supporting Canadian tech. If you remain on other platforms, a tariff is being paid to U.S.-owned companies in Texas or Michigan on every mortgage you advance on one of those systems. Awareness of our choices, both personally and professionally, in these times is critical. So that's the comment there. And then, there's just a ton of stuff below, people supporting it, people saying, hey, who cares? Other people correctly pointing out that actually it's not a tariff. That's not the right use of the word because tariffs don't apply to services, which Jeff went on to agree with. He did correct himself there. And yeah, I'm not going to make a comment on, which choice and what you should go with. I think he is right in saying that when he talks about Texas, he's talking about Filogix, which is owned by Finastra, which is Vista Equity Partners. And Michigan, he's talking about Finmo, which is owned by Lendesk, which is then owned by Rocket. So those are true statements. And so, yeah, I mean, for me, like I said, I don't make a comment one way or the other. To be personally, I'm more of a economic libertarian. I don't like tariffs, and I think everyone should just choose what is best for their business, and that should be the one and only criteria. But yeah, I wanted to bring it up because it actually did cause quite a bit of a stir in the Facebook group at the very least, and I think it's, just an interesting way that people are reacting to this. Of course, some people are making posts like this, like Jeff, highlighting these differences, and then, people in the comments either kind of defending or agreeing with Jeff in that respect based on more or less, probably the colors that they fly elsewhere. And so really that's the post, and it's just interesting and to see more of this type of stuff going on. But I guess the two kind of big things I want to point out as it relates to this, first is, of course, just people, I think in general, businesses, I think, honestly, it's probably a good move. I say, hey, don't fail to take advantage of a good disaster. I think that normally applies to politicians, but I think you can apply it here. And I'm not going to pick on Jeff here because you know what? We actually did it ourselves. We changed our price. We used to price it in USD just because we had some costs in USD. It caused quite a stir. It never did for months, for years. We had it in USD. No one really cared. And then in the past 3 months, it's caused us. We probably lost multiple deals because it is in Canadian. Sorry, it was in USD. And so we switched it. Then we did an email blast saying we're Canadian and we switched it. And this is the reason why. And so, yeah, it's interesting just to see how people are. This is a big event. It's on a lot of people's minds and how different people are playing it. The other thing that I think that is going on here is that I think it's right in that there is a fundamental shift. I think people are fundamentally, and even if all these tariffs go away tomorrow, I think there is a little bit of a bitter taste that's going to take a long time to go away as it relates to US products or just, US funded companies. And so I think that's interesting. I think, the first of all, I'm going to be very curious to see how it plays out on the ground. In terms of US owned companies, we talked about a couple. Jeff did in his post there. The only other ones I can think of are like Jungo, maybe other types of, I'm in the CRM space, so maybe like a Pipe Driver on Monday. I think those are more US companies. So we'll see if there's a shift there. I don't know, maybe not. But that's one aspect that I'm going to be really paying attention to. But I guess the other thing about tech and all this that I'm actually more interested in is just how this affects maybe the funding landscape. And the only story I really know that well, and I don't actually know it that well, I only know it kind of briefly. And so if anyone knows it better, they can correct me. But I think it's the story of Finmo, right? And so what I know of them is they start up, they did some great stuff. They got funding, and that funding was based in the US. I think I'm almost certain was. Again, if someone knows better, please correct me. And then they went through, and then of course they got their exit with Lendesk, which was then backed by Rocket Mortgage. And so now if there's this divide, if now we say, hey, do you know what? We don't really want to have US owned companies. And so US funders, US VC firms, PE firms, whatever it is, don't want to back Canadian companies anymore, then maybe there isn't that funding in Canada anymore. Maybe that story that I just described to Finmo doesn't happen because they're a startup, but they can never get their wings. They can never get off the ground because the funding that they got from the US isn't there. And the funding landscape in Canada just isn't nearly as liquid as it is in the US. And so, yes, I think that it's important to have, a good opinion on what you think is going on and reacting accordingly. But I also think that more than anything from a tech perspective, what this means is that it's going to be a bit harder for Canadian startups to get the funding they need to get off the ground. And that could stifle things a little bit. And maybe the silver lining is that it kind of gets our acting gear to say, hey, domestically in Canada, we want to really build out this funding landscape because historically we've just relied on the US for that funding. And instead, we're going to self-fund. That would be maybe the optimistic outlook on this. And who knows, maybe we'll get there. But I think it's just a very interesting thing to see. It's not just about the products you buy. It's not just about the companies you support. It has all these trickle-down effects that really affect entrepreneurs in this country and tech entrepreneurs. So we'll see where that takes us. Okay, story number 2. We're going to keep rolling here. The second story I want to talk about, again, we are going to go a little bit south of the border, but I just want to talk about it a little bit and some of the trends that I'm seeing out of this. So this was actually something that Scott Peckford, he has this newsletter that he sends out, and it came across on that. And what it is it's actually an Instagram reel that talks about, and it's a Wolf of Wall Street clip, which is hilarious. I'm a big fan of Wolf of Wall Street, but in any case, it talks about loan officers over the past couple of years. Loan officers is basically what they call mortgage brokers in the US. And I'll just read out these numbers. So in 2022, which was kind of just still coming off that peak, there was still, a decent amount of optimism in the market. There was 395,000 mortgage brokers. And so for context, there's about 25, depending how you count it, mortgage brokers in Canada. And so what is that? That's about 20 times the number of loan offers in the US. Okay, pretty good so far, pretty high numbers. 2023, there's 343,000, so that's down. 2024, 150,000. So it's halved. It's less than half the number. And now 2025, the number it's showing is 93,000. So if you still have that 25,000 mark, which was the Canadian number, we went from 20 times to 4 times. So it's just been a massive downsizing. Really crazy to see that. And I just want to highlight that just again, because it's such a crazy swing in the numbers. But I think it deserves a little bit of an explanation of why is that. And I've talked to actually a couple of US brokers, not that we do a ton of business there, but I do chat with a couple of them. And the biggest difference, of course, is they don't have 5-year renewals, right? You lock in A lot of people locked in 2021, 2022 at record low rates, and they locked in for the remainder of their term. They can literally lock in one of these mortgages for 25 years and just pay the rest of their mortgage at these super low interest rates. And so that's what so many people did. And again, I'm talking to some of these people, what people did from basically 2000 to 2021 in an environment where the rates just continually went down, they just cycled their book. They just, every couple of years, they called up their client. They said, guess what? Rates are lower again. Let's refinance you. Let's get you in a lower rate. And the client said, sure, great. And so that's probably why it was so inflated for so long, is because they were able to churn these books as rates went lower and lower in the US. But that parade is over. That music has stopped. No one is going to be refinancing at higher rates. I think there's like 200 basis points on average in terms of what people are locked in at right now versus the prevailing interest rate. So no one is going to be refinancing. But the other crazy thing too is no one's even moving because of this. People are saying, hey, I'd love to move. Maybe, I don't know, there's a new city that's really exciting to me. I don't know, maybe I want to upsize, but I'm not going to, because if I move, I lose this amazing rate that I have. So not only is it limiting refinances, but it's eliminating the secondary market on purchases. And so where does this all kind of lead? Again, in the conversations that I have, people saying, yes, a lot of people are leaving. We're down, you saw the numbers, 75%, whatever it is. And really a lot of the business just ends up being maybe some second mortgages if people need to pay down credit cards, because again, credit card balances are going way up. Maybe, HELOC to do the same thing. New builds, new purchases, first-time home buyers. Obviously, there's still a little bit of a market for that. So, the really smart people are making really good relationships with builders and doing that sort of thing. And so, I think this just kind of speaks to a bigger trend. I think that I've talked about on this podcast as well on my Instagram, Mortgage Tech Tom, is that basically we're in a point where the typical thing that mortgage brokers, loan officers used to do, which is help you get a good rate, there's not as much value in there anymore. And there's 1,000 reasons why, but this is just another good example of that. And I think just what this relates to, I guess, just in tech and in general, managing your own business, mortgage business, is evolving, right? Evolving from just being the person who can get a rate for you and tell you what you can do with that, to being the trusted advisor, being someone who can look at that whole financial picture, ask people about their credit card debt, see if there's an opportunity to get them in a HELOC, whatever it might be, and then using tech to find those trends very quickly and to act on them very quickly. Okay, cool. All right, the last story that we're going to talk about is this bit of an interesting one, and we'll get into it. And why it's interesting is it has to do with Pinch Financial and DLC. They just did a partnership. So I'll share my screen here just for a second. And what you can see here, I'll just read the headline. It says Dominion Lending Centers joins Pinch Financial's AI platform on Realtor.ca. Broker network DLC has announced a partnership with Pinch Financial in a deal that would add the network, one of Canada's largest, so that's referring to DLC, one of Canada's largest, to the fintech technology platform, that's Pinch, which is used on listings such as Realtor.ca. So that's the article, and I'll just stop sharing there for a second. And if you're not, as a quick plug, if you're just listening to this, please join our YouTube. You can see all the things that I'm showing on my screen here. Love to have you over there. But that's why I read that article. And just quickly, talking about that, on the more tech side, of course, the Pinch platform, I don't know it so well, to be honest. I've heard the name many, many times kind of being thrown around. I think one of the best things that they have going for them is that integration with Realtor.ca. I think they secured that distribution deal, and I think it's probably been a wonderful business opportunity for them. So kudos on that front. In terms of the AI and that side of things, like I said, I'm not super familiar with the platform. Are they using AI? Probably. Is it adding efficiency? Probably. It's probably adding 10 to 20%. I don't think it's this, new way of doing mortgages. That would be my guess. Again, I might be completely wrong, but just the kind of test that I say, hey, if it, tripled the speed of getting approval, we probably would have heard about it a little bit more. And I say we, just the general mortgage community. But hey, prove me wrong. If someone uses Pinch and knows better and says, yeah, actually, it makes my life 100 times easier, love to see it. Love to have you on the program. Love to kind of showcase it and see what's going on. So anyways, that's the tech side of things. And, I think it's good for Pinch, good for DLC. I think partnerships are great because they help each other out, right? You wouldn't go into a partnership if it wasn't mutually beneficial. So I'm always in general a fan of partnerships. But here's where it's interesting, and here's where I really wanted to dig into it. I was at first, when I saw it, I was a bit confused because I thought Pinch had some sort of relationship with him. Not 100% sure the nature of that relationship, but I thought there was something going on. So I thought, okay, DLC, M3, pretty fierce competitors. Now Pinch, who I thought a relationship with M3, is now doing a deal with DLC. What's going on here? I don't know how this completely adds up. And so whatever, I didn't think about it too much. But then in doing this episode, I came back to this and I said, hey, is there a story to be had here? Maybe, maybe not. And when I scroll to the bottom of the article, and I'll share my screen again here, there is this disclaimer, clarification. It says, a previous version of this article referred to M3 Financial Group's purchase, so there you go, that's the nature of the relationship, of Pinch Financial in 2021. However, M3 has since sold that interest in the company. So very interesting there. I don't know the ins and outs of anything that's going on. As you probably tell in my preamble here, I didn't really even know the nature of their relationship until I really got into it. But I just think it's maybe more than anything an interesting reflection on what's going on over at M3 and M3 Tech. I think for many years they were aggressively looking to partner and potentially acquire, I guess in this case, tech platforms and help their tech ecosystem here. But this is obviously a step back. And so, I think we talked about this on the program a couple episodes ago. We talked about Jerry Lowe being the head of M3 Tech over there. And, Jerry, I know him pretty well. We've had a bunch of conversations. If I had to guess based on conversations I've had with him, they're probably just focusing kind of on their core competencies, being the boss platform. I think that's always the yin and yang you have to deal with in terms of a tech ecosystem. Of course, more things involved means more connections, which means more synergies, which is great, but it also comes with added complexity, and maybe this is a complexity that didn't make sense at the time. I don't know. I'm just speculating here, but I think there is an interesting parallel to, again, themes that we've talked about on this program where almost brokers felt the same way, where they were told, hey, we need to have 1,000 different tech platforms to use in order to make your business efficient. And now what we're seeing in the marketplace, people saying, yeah, that was great, but I'm scaling back. I'm focusing on a few core tools. Maybe we're seeing it at the corporate level. Maybe we're seeing it at that investment level. So just a little bit interesting there. And we'll see if that trend continues. So anyways, we'll leave it at that. Thank you so much again for listening. I hope this was a good episode of